What are we waiting for?
Primarily to give everybody a chance to log on, but Andy, why don't we go ahead and get started?
Yes, I was going to say that. Yeah, so it's time.
Okay.
Thank you.
You betcha. You bet. Well, welcome everyone. Thank you for joining today. Our apologies for making this a virtual workshop instead of one in person. The in-person workshops are pretty interactive and a lot of fun, but because of the weather and because of the risk of issues for people, we decided that this might be a better way to proceed. My name is Mike Lyons. I am going to be your facilitator for the workshop today. My background is primarily in manufacturing, both hardware and software, as well as in consulting. So I've been doing a lot of work over the last 45 years or so, running companies, managing people, working on and focusing on operations, buying and selling companies, and have a pretty good feeling for what it takes to make a successful business. And my hope is that this evening, regardless of where you are in your journey of starting a business or growing a business, the information that we cover here will be helpful to you. I will ask for a couple of housekeeping things. If you don't mind, would you put yourselves on mute unless you have a question? That would be really helpful. Sometimes we get background noise and that becomes kind of an issue for folks. So that'll be helpful. I also sent out earlier yesterday evening a series of handouts. There are actually 3 of them. One of them is a PDF of this presentation that you're welcome to use and refer to as you're going through the workshop this evening. And then there were a couple of other documents that we'll talk about as we move along. One is a checklist, and the other is a glossary of terms that I thought would be helpful to you. A lot of what we're going to talk about today is about financial reporting and how important financial reporting is to running a business properly. But sometimes when you talk about a topic like financial reporting, there's a whole backstory of context that's helpful. And so part of what we're going to start with this evening is talking about that context and what it means in a small business to be able to have time and create discipline and routines to look at financial reporting. So we'll focus on some context here. Another thing I want to let you know about is a lot of these slides, particularly the ones related to the technical issues on financial reports, has been generated by one of my SCORE colleagues, Mr. Tom Moore. Tom has done a fantastic job in putting this together, and you can pick up and participate in a number of Tom's workshops that are posted on this Denver SCORE website. So if you see things in this presentation that are appealing to you and you want to learn more, I would encourage you to look at the website and sign up for one of Tom's webinars. They're really helpful. He does a great job of them. One last thing is if you're just joining and haven't done so already, if you would be kind enough to put your name and email address in the chat window for this webinar, that would be really helpful. One of the things that we'll do is we'll send you a survey after the workshop, and we'd like to get your feedback on how it went and what you got out of it. So that's that would be important to us, and ask that you would help us with that. I'm going to ask before we get started if there are any specific questions or any topics that you'd really like to cover. So take yourself off of mute and help yourself to answering or asking any questions that you might have.
Anybody wanting to?
Okay, we'll take time for questions as we go along. So, okay, let's dig into it. So, as an entrepreneur, you've got a lot of things going on, and there are a lot of different topics and issues that you're going to have to balance. Things that you're going to have to deal with. Some of them are going to be planned, and many of them are going to be very spontaneous. Fortunately, most of us and those people that are really well suited for entrepreneurship have this gift of energy. They have the ability to do the things and focus on the things that are required. But as this illustration depicts, oftentimes, our job is just to keep these plates spinning. And what we're going to talk about today is one of the effective ways to keep all of these plates going at the same time. And that is to be proactive in your business as opposed to reactive. So my encouragement to you is find ways that you can proactively pursue running your business well and spend less time being reactive in your business. And what we're going to hear about tonight is the notion of using financial statements, financial reports to help you be more proactive. That's one of the ways to make sure that you've got a lot of the many things that you've got going on can be controlled more proactively. And I would encourage you, don't be fooled by the expression on this guy's face. All of us who have run businesses, large and small, always run into issues. So it's just a matter of finding ways to be more in the proactive camp as opposed to the reactive camp. Another thing that I would ask you to keep in mind is this notion of an empty cup, right? We're going to cover a lot of different topics this evening, and it's really helpful if you kind of suspend judgment, kind of have an open mind for the things that we cover. If you have questions, feel free to ask them. But it's not helpful to come into the conversation with the notion that you've already know what you need to know and you're just doing this to satisfy something else. There's a wonderful story about a Zen master who invites a student to come and sit and have tea, and the Zen master asks the student, what do you want to gain from this conversation? And the student gets into this long diatribe and this description of what he's looking for and what he needs and what he hopes to get. And he just keeps going on and on and on. And the Zen master starts pouring tea into his cup. And ultimately, the cup fills up all the way to the brim and starts spilling over onto the table. And the student, is alarmed and says, "What are you doing?" And the Zen master says, "Our conversation together is kind of like this cup. I can't put more tea into it until it's empty." So approach this with kind of a beginner's mind, an empty mind, where you're open to considering some of these concepts and these ideas and these routines and this information that we're going to be discussing. So this is a very busy slide, and I apologize for it, but at the same time, I want to encourage you to think about the various messages that are happening here? In running a business, it's often helpful to compartmentalize tasks and subjects to keep them organized. And that's kind of what this graphic does. On the left side, say above that sort of purple pyramid that you're looking at, it's about people and relationships and reputation. You see that dark circle with reputation in the middle of it. And this is about getting and keeping and growing your reputation, your relationships, the people that are so important to your business. Now that's going to be employees if you have them, but it's also going to be your customers or clients, and it's going to be your shareholders. Now that shareholder description might also include, people in your family that depend on your business for a living, or people in your community that benefit from having your business be, active and thriving. So this is all about, on that left side, this is all about those relationships and people that are invested and are shareholders or employees or clients in your business. The way you keep them engaged, and I want to point this out to you, is you see that little purple, or that little box off again to the left that says vision. So the way you do that is through execution of your vision, of sharing with people what your vision is, of encouraging people to sort of hook into your vision, making your vision a reality, planning to your vision. All of those things are really important. And while you're going to be very busy doing a bunch of stuff on the right-hand side of this graphic, you're going to need to spend at least 1% of your available time focused on vision, focused on where you're going, focused on changes about where you're going, and making sure that you're focused on doing the right things or what to do. As the business owner, that's your job. You've got to be able to drive that, that vehicle in that direction. If we take a look over to the right-hand side of the screen, this is all about things that you do, transactions, right? You make or buy solutions, you sell them, you keep track of them through record keeping. And this is about being productive. In this side of the balancing beam here, we're talking about doing things faster, better, cheaper, if that's appropriate. And the way you get your products or services and how you sell them and how you keep records of them and how people in your organization know what to do is through that box titled in alignment. So 99% of your time is going to be spent on aligning things, focusing on productivity, getting the transactions right, the processes right, the procedures right, getting people aligned with one another and aligned with clients. Those are all going to be part of the activity that you see happening on that right side of the screen. And instead of doing the right things that we saw on the left-hand side, we're going to be doing things right on the right-hand side. Excuse me. That pyramid in the middle, we'll talk a little bit about a little later on. But what I want you to consider here is how these two pieces balance and how really you have to keep them balanced as the business owner. You have to do a great job on the relationships with people, your vision, but you also have to get the productivity right, the transactions right. I hope that makes sense to you. Another thing that I'd like to bring up, another piece of context that I think might be helpful to you here, is something that comes from a wonderful business book by Jim Collins called Good to Great. If you're in this to kind of exercise, if you're in this business, to kind of exercise a passion, to be the best you can be at what you're doing, I would encourage you to pick this book up. You can pick it up at Amazon or wherever, but it's a really helpful resource for understanding business. And admittedly, it's a little dated, but it has some wonderful information in it, great concepts, and they're timeless. They apply as much today as they did when it was written. But this hedgehog concept is something that kind of is the intersection of three key principles that need to be in place for you to be successful in your business. First of all, you have to be passionate, right? You have to have a passion for your business, because starting a business, growing it, running it, seeing it to the end is difficult. It's hard. And you're going to have to build up resilience. You're going to have to be able to thrive while at the same time dealing with so many problems and a lot of issues. So if you don't have a passion for it, like Steve Jobs says, you give up. You're like the rest of, or the majority of people who, when they find it too hard, they just give up and they put the business aside and they go on and do other things. But if you've got that passion, that's really an important ingredient to your success. The next thing that you've got to have is you've got to be able to be the best at what you do in some way or fashion. And this says to be the best in the world, but the idea might be to be best in the community that you serve, or to be best in the geographic region. And this goes back a little bit to what we were talking about with reputation and relationships, that whole notion of brand. But if you're just like the next guy, if you're not distinguishing yourself by being better, then it's going to be really, really hard for you to grow your business. And it's going to be really, really hard for you to compete, because if everybody else is dealing and providing the same level of service or the same product, it's a tough game. So think about how you can distinguish yourself by being the best at something. Then last but not least is what drives your economic engine. So today I had a chance to talk to somebody who's starting a consulting business, and their economic engine is billable hours. That makes sense, right? You bill your hours based upon your expertise and your skills that people want. And so billable hours would be a wonderful way to kind of describe your economic engine. Maybe you're selling products. So selling products and the products you sell could be your economic engine. Maybe it's delivering services. Whatever it is, it's important that you understand sort of at a fundamental level what that economic engine is. And some of the financial reporting that we'll talk about a little later will describe a lot of that for you. Are there any questions at this point about what we've covered so far? Okay. So here is that planning pyramid that we talked a little bit about in an earlier slide. And this is something that I'm going to encourage you to consider. Now, you don't have to do this exactly the way the illustration points out, but the key element here is that you want to have a structure for your business and for how you operate your business that is conducive to keeping informed about what's going on, knowing where your market's going, knowing what your employees are doing, knowing what your customers think. And if you're not using some structure, it's going to be really, really difficult to maintain a good sense of your business. Now, this structure, as you can see, starts with your core values. What are your core values? How would you describe how you should behave, how your employees should behave with respect to doing business going forward? This is a should statement. This is a statement that is kind of describing what's happening or what you want to have happen in the future. The next level up is purpose. Why are you doing it? What's your why? There's a wonderful author out there called Simon Sinek. If you don't know Simon Sinek, look him up. He's on TED and a number, and he's got some great material. But he talks about why you're in business. And why is so important because, as we talked about earlier, it connects to your passion. It connects why you want to do things to the results that you're trying to get. Next are targets. I would encourage you to look at your business from the perspective of what do you want to have happen 3 to 5 years out, right? What do you want to do? Where do you want to be? Is it early on where you want to be growing your business? Do you want to be adding products? Do you want to be adding employees? Do you want to be partnering with somebody? Or maybe do you want to sell it, right? You should know what you're looking for 3 to 5 years out. Now that'll change, right? But you have to have that orientation. Looking down the road is an important aspect of where you want to go and how you're going to get there. Next are goals. So these goals support your targets. Goals are typically annual, and you want to set them every year. If you don't spend time in your business setting goals for yourself, I can almost assure you, you'll never reach your targets, right? Next are actions. These are quarterly activities. So this implies quarterly planning. You get together with your leadership team or your stakeholders or your investors or whatever, and spend some time looking at what you want to accomplish this quarter to help you achieve the goals, to help you then achieve your targets. You can see how it starts to build one after another. Next, schedules. This is really talking about what you do weekly, how you set priorities, how you move forward in your business with respect to things, short-term things that you want to do. Not only is it for you, but it's for your employees. And sometimes it may apply to your partners. You've got to be able to have that ability to know what you're going to do this week, even know what you're going to do tomorrow. What you do tomorrow will help you with your actions, will help you with your goals, will help you with your targets. So you can see how that's built up. And last but not least is accountability. And we're not going to talk a ton about accountability this evening, but if you were to ask me, what's the single most important concept or principle as a manager of people, I would tell you it's accountability. People have to be accountable. You have to be accountable, right? If your business succeeds or fails, you ultimately, as the business owner, are accountable. And the same thing has to be able to apply to your employees. If you've got people working as managers or as shipping clerks, whatever their role, know what they're accountable for and make sure they know what they're accountable for. Okay, another concept, and I promise we're going to get into the financial reports here soon. Another concept that I want you to think about in your business is, are you going to be primarily a relationship-based organization, a relational organization, or are you going to be a transactional organization? Now that may seem kind of a cosmic question at this point. Perhaps it is, perhaps it isn't. But there's some distinctions here that I want to encourage you to think about. The first is, as a relationship-based organization, you're going to primarily engage people's trust, right? So this is kind of that notion of, doing business because I trust you, because I can count on you, because you're reliable, because you do what you say you're going to do, because you make things good. If they're, if I get a product shipment and something's broken, you make it good. So relationship-based organizations are very trust-centric, very customer client-centric. They focus on what the experience of the client is. So think about that in terms of, doesn't any business care about what their clients think or say? Well, you'd be surprised. There are some companies, some businesses out there that are really more focused on getting the next client. So I'm not so worried about what my past clients thought or did or experienced. I'm worried about getting the next guy. So a relationship-based organization, a relationship-based company is very focused on the client experience. They're focused on client retention. So this is the notion that if I have a client and they trust me and they know I'm all about their experience, they're more likely to come back and engage with me in my products or my services. So doing a good job and being a trusted provider helps with client retention. And client retention translates into something interesting called client lifetime value. I work with an organization, a consulting business, and they are growing at leaps and bounds, right? They've got a 25 to 30% growth rate year over year, and they've been in business for the last 7 years, just doing phenomenal. They're adding people, they're getting new clients. But interesting thing about them, their revenues went from 13 million to 46 million. And at 13 million, 80% of their business came from returning clients. At 46 million, 70% comes from returning clients. So what they put their growth rate, what they attribute their growth rate to is the fact that they have this very loyal, stable group of clients that they can keep going back to, finding new projects, new things to provide them, new value to add. And it's a wonderful business model. And that is a relationship-based business. On the other side, think of it in terms of transactionally based. So this is about being very efficient. It's about customers, not clients. Now you may ask that question, what's the difference between a client and a customer? Well, if you're familiar with the department store chain Nordstrom's has clients. Clients come to Nordstrom's, they have an experience, they know that if they don't like what they have, they can return it, no questions asked. And they're kind of the leading aspect of that relationship. It's the client. In the case of a transactionally based company, we're talking about customers, people that come in, they can buy your product or services from a wide variety of different sources. And I've got reference down here, McDonald's. McDonald's is an extremely successful business, but their business model is very transactional. So they want you to come in, they want you to buy stuff, and they want you to go home or go somewhere else, or maybe spend some time in their dining room, but then go. They're not trying to make the experience just such a wonderful thing like Nordstrom's is. Transactional based businesses focus on transactions. They focus on profit, cost, and price. They're all about acquiring new customers. So they're trying to take customers away from their competitors. They're trying to find new customers. Perhaps it's in McDonald's case, it's kids that they want to sell to. It's seniors, it's people in between, but it's all about acquiring new customers. And it's also about price per transaction. So instead of a client lifetime value, it's about how much can I sell in one transaction? Do you want to supersize that order? Do you want large or small fries? You know, how about a sundae or a shake? So it's about driving that price per transaction up. And that's kind of indicative of a transaction-based company versus a relationship-based company. Does that make sense? Thoughts about that? Okay. Next thing I wanted to chat about, and we'll go through this quickly, is the client matrix. And this matrix looks at the combination of clients across the bottom and solutions horizontally, or vertically rather. And it's a helpful way to illustrate the effort and cost required to address each of the 4 sections here. So you can see they're numbered. Number 1 is selling your existing solution, whether that's products or services, to existing clients. Once you have a client base, even one client, it's a lot easier to sell to a known entity than it is to start from scratch. So selling existing solutions to existing clients is probably the path of least resistance for your company, for your organization. It also tends to lean you towards a relationship-based business, because if you have those clients and you can sell to them, you develop stronger and stronger relationships. It kind of makes sense. The next one, number 2, existing clients, but new solutions. So here you've got the relationship, and now you're trying to sell new products or new services to that customer. That's a little bit harder than selling to an existing customer, or excuse me, an existing solution, but you can do it. Next is number 3, is selling to a new client an existing solution. So this is where growth comes from. This is typically how companies grow. I've got my solutions, I've got my products or services, whatever they are, and I try to go out and build a larger client base. So that's generally speaking how people grow, number 3. Number 4 is new solutions to new clients. That is the antithesis of number 1, which is selling existing clients, existing solutions. And new clients, new solutions is tough. And it's a large reason why beginning businesses struggle, because everything's new. They don't have a relationship. Their products or services tend to be a little wobbly. And so it's difficult to get started. But that's where most businesses, startup businesses, begin, selling new clients, new solutions. So we talked a little bit about, the idea of, doing right things right and doing the right things. We've talked about the planning pyramid. We've talked about being a relationship-based versus a transactional-based organization. We've talked about the client matrix. One of the things that we're going to now start to talk about is this notion of planning, and this idea of using information to help you. And one of the ways to do that is through what I call pre. So this is pre-work, right? Pre-strategy, pre-goal setting. Pre stands for, it's an acronym for planning, reflection, and evaluation. And you're going to hear that term or aspects of that term, the planning part, the reflection part, or the evaluation part, used over and over again as we talk about our financial statements and the planning process. So it's an important part of your business. And it's, again, very helpful in keeping you out of the reactive mode and more proactive by looking at how you're planning, reflecting on how your business is going, and evaluating the results you're getting. Those are always good practices to have to keep you more proactive and less reactive. The other thing that typically happens in companies as they start to grow is that they become a lot more complex. And that illustration at the bottom here is really trying to help you understand that concept. On the left-hand side, you see those two people standing side by side with the arrows in between them. That reflects a simple exchange of information or ideas, a simple communication between two people. That's a 2 to 2, right? I can talk, you can talk, I can listen, you can listen, 2 to 2. When you start to look at it by adding a third person, it starts to become more complex, 3 to 6. Now, maybe that's an employee, maybe that's a client, maybe that's a shareholder, whatever the case may be, it becomes more complex. And then you get more people added to the equation, and what you find is that your business becomes really more and more complex for you. And it may seem a stretch to take complexity and attach it to these financial reports that we're going to talk about, but it's a relationship. It's a way that complexity shows up in your financial statements, and your financial statements have a way of helping you simplify complex issues in your business. So that's why I add this here, is just to kind of give you a sense that as your business grows, it's going to be more complex, but you can help deal with that complexity through financial reporting. Okay, so what would you do in a planning, reflection, and evaluation session, right? We talk about this 1% vision. This kind of falls under that heading. What would you look at? Probably the first thing you'd look at is what's going well, right? Yeah. Do you need to do anything to keep what's going well in place? Maybe it's an employee that's doing a great job, a critical job for your company. Do you have to do something to help that employee stay in position? Are there changes in technology or in the business environment that could threaten your business? You know, it's going well now, but don't rest on your laurels. Look forward. You know, what's happening out there? A good example of this might be Blockbuster, right? In the year 2000, there were 9,000 Blockbuster locations across the country. Today, there's one, and it's a tourist attraction in Bend, Oregon. So what happened with Blockbuster? They weren't paying attention to where Netflix was going or where streaming providers were going. So that's the kind of thing that I'm talking about. Where is technology going that might influence or impact you? The other thing is, how do you find that out if you're just by yourself? And one of the ways to do that is through industry organizations. So look at it from the point of view of, if there's an industry organization out there that you can belong to, it might make sense to pay the membership fees or the dues to at least have access to the material that they offer. And they'll talk about things like data in your marketplace. They'll talk about trends. They'll talk about threats. They'll do SWOT analysis typically for the industry. And these are all really good resources for you to use to look for what might be a disruptive technology or a business change that could impact you. So one of the things that you want to do as you do this planning, reflection, and evaluation is give consideration to that. And industry organizations or trade organizations are good ways to do it. Next, what isn't going so well? So can you fix it? Or should you kill it? One of the things that we find in small businesses is that people become really attached to their solutions or their products. And that's understandable. You know, they're our babies. We work them, we nurture them, we spend a lot of time with them. But the fact of the matter is that if they're not selling, or if they're not producing the margins that you're looking for, the profit you're looking for, then you really need to think about maybe letting them go, killing them. Or perhaps they're adjunct products or services that you could sell that aren't exactly the same thing, but could be used to, keep your sales going. A lot of businesses that are successful today started off doing something totally different. And what they learned was their initial product offering or their initial service didn't make it, but through ingenuity and creativity, they figured out, okay, well, I can take this product, I can apply it this way, and I can make it do something different. There you go. That's what we're talking about here. It oftentimes allows you to leverage your existing clients. It allows you to use marketing investment that you've made, and it creates oftentimes goodwill with your client base. So some things to consider if things aren't going well in your planning and reflection and evaluation mode and that process, look at ways that you can be creative and take something and change it and apply it to your market in a different way. So here's an example of something that I came across, a personal experience that I had, and this is where I'd love to get your input or comments. I had a handyman come to the house and asked to have a sink installed. By the way, this is not my bathroom. But what happened was a person came to the house, they looked at the job, they evaluated a wide variety of different things, the size of the sink, the drain, the placement, where it was in the bathroom, where the drain went, all sorts of different things, and gave us a quote. It's a very attractive quote, probably one of the better ones we've had. We had it bid out several times. So on the day of installation, the installer came to us and started on the project, and about half an hour or so came to us and said, this was underbid. The guy that was here didn't know what he was doing. He was really kind of a novice, and so he didn't pick up all the stuff that was necessary. And so here's your new quote. So I looked at it, and the new quote was almost double the original one. And I reluctantly said, since the guy was there and I could get it done, I reluctantly said, okay, well, if you can do it for this price, then go ahead. So another half hour or so passed, and he came back and he said, well, I can see here that you've got a couple of other things that need to happen, and I'm going to have to add dollars to the quote, and gave me a new quote. At that point, I told him, I'm not interested. You're going to need to, get your tool bag and head on out. I'm not going to do it for that price. What was interesting was I really thought after he left, I would get a call from the president of the company or the owner or a manager with a new quote or new information or an apology, if nothing else. And I got nothing, right? Nothing happened that had me feel loyalty and a sense of relationship with this company. And so my question to you is, how do you think that would make you feel if that were your company and these people worked for you? What would you do differently? Anybody? Any thoughts?
Yeah, I would have called personally as, the business owner. It's your name and it's your company, it's your money. And then if, you lose a client, and then if you hear somebody talking about that company as well, you're going to hear somebody's feedback. And then
Yes,
you're going to be reluctant to hire that company because you heard those negative comments.
that's exactly right. Yeah, 3 great points that you made there. First is they spent a lot of money coming to my house, giving me quotes, sending people out here and sending them home without any business or a project. That was costly, right? Second, what do you think my neighbors know about this company?
Not a good company.
Not a good company. Don't do business with them. In fact, a neighbor up the street happened to hear from another neighbor that we were looking at having a sink installed, and he came and asked. He said, "What do you think of the company? Did you get your sink installed?" And I told him, don't go here. Don't deal with these people, this company. So you're absolutely right. Yeah. Anybody else? Okay. So if you want to know how you're doing, first thing you want to do is establish some systems, including accounting systems, to help you monitor and accomplish your plan. So you will have a gut reaction probably every day to how your business is doing. Somebody called and gave you a great reference. Oh, the business is doing great. Somebody had problems with a product or a service. Oh, the business has got a problem, right? That's certainly the way I ran my business for a long time. It was all about the experience I had moment to moment, day to day. And that's fine. You can, that helps you, that sensory information helps you be a better manager and owner, but it can't be all you work on. So you've got to be able to have systems in place to give you empirical, data-driven information about how your business is doing. And the way to do that is establishing primarily accounting systems. One of the things that you want to be able to recognize is that your accounting system, or any of the systems that you put in place, maybe it's a manufacturing system, whatever, you're going to need to rely on both internal and external resources. And this is a key point. If you're a sole proprietor and the only person working in your company, you've got too many hats to wear. It's lots and lots of work. So think about finding people outside the organization to help you. Maybe that's a bookkeeper. Maybe that's somebody to help with sales. Maybe it's a delivery person. Whatever the case may be, think about your organization in terms of internal, what can be done internally and externally. Regularly review your results. Now, when I say regularly, I'm talking about probably monthly if you don't do it more frequently. Monthly makes sense when you're established and you're going. It may make sense to do it more often when you're getting started, you're ramping up. But regularly review your results, right? And while you're doing it, give yourself time for that pre-planning that we talked about, right? Looking at what's happening, the planning part, the evaluation part, recognizing what's involved there. Because this takes, while it takes a lot of time and it takes discipline and effort, it's so important to you to make sure that your business is running properly. And if you don't have that empirical data coming in for you, you're going to have issues. It's going to be tough. And if you've got issues and you're dealing with the day-to-day stuff of keeping all of your plate spinning, it becomes almost too much. So find areas where you can be proactive. And one of those areas is setting up these systems, these accounting systems primarily, so you can see how your business is running. The other thing that's important is to adjust your plan for current facts and circumstances. Remember, we talked about looking at what's going on in the industry, looking at what's going on in technology, making sure that you give yourself time to think about those things. And again, it's difficult to pull yourself away from the day-to-day stuff, but it's so important to do. So give yourself that opportunity to do that pre-work and look at your financial reporting. Okay, so let's pick up our financial statement review. And I'm going to take a quick drink here. I'm really not used to talking this much, so my throat gets dry. So we talked a lot about context. We talked a lot about what's happening within the organization with respect to how to plan, how to evaluate your situation, what to look for. So now let's start to think through the financial plans themselves. So what we're going to do is a couple of things here. We're going to really look at, let me get to it quickly. We're going to look at 3 different types of financial statements. Right? We're going to look at an income statement, we're going to look at a balance sheet, and we're going to look at a cash flow statement. Now, these 3 statements are kind of the 3 universal statements that almost every business owner or CEO or banker or whatever will look at to evaluate your business. If you want to apply for a loan, you're going to have these 3 financial statements, and they're going to have to show a good story in order for them to make sense and in order for you to get funding. So a couple of best practices here. I would encourage you to think about, and when you're going through these financial statements, to look at items that you can do something about, and you should have a way to kind of prioritize what you're going to focus on. And what I would encourage you to do is focus on those things where you can have the greatest impact. And I'll give you some examples of that here in a little bit. The next thing that I would encourage you to do is use comparative financial statements with change columns to help you compare current results with prior period results. Maybe that's last month, maybe that's last quarter, last year. But if you're just looking at current period, that's really not going to tell you enough about your business. So look at it from the perspective of comparative financial analysis, looking at prior periods. If you're using a bookkeeper, bookkeepers should be able to do this. If your bookkeeper is looking at Quicken or using Quicken or some other automated tool or system, they should be able to generate these reports for you fairly quickly just through day-to-day transactions. So these are not hard things to do. These are things that should come relatively easily for somebody in accounting or a bookkeeper. So these comparisons help you understand perspective. They give you a sense of relevance to the numbers. They help you understand materiality, and they bring clarity to the discussion. The other thing you want to do is utilize key supporting reports to go deeper once you've taken a look at these three statements that we're going to look at. It's important here because a lot of times the three statements that we'll look at are going to be summary documents. They're going to have summary information in them, and you're going to want to be able to look at detailed information to help you understand what's actually changing, to see the detail. And a quick little story. I was a CEO of a company after the previous CEO left rather suddenly. And I had a CFO, and I met with him, and we talked about, how the company was running, and he brought me a series of financial reports to look at. And I sat down and went through them with him, and he explained the information that was important. And after the conversation, he gathered up all his papers and walked out. And I took a few notes. I wanted to keep track of some of the stuff that he had mentioned. But I let him walk out with me believing that those financial reports were his job. And while his job as CFO was to put those reports together, my job as CEO was to interpret the reports, to organize resources in response to what the reports were telling me, and to be accountable for those reports. And it took me a while to figure that out, because it's easy to say, oh, that's a financial report. That's his problem. He's going to put that together, and he's going to figure out what needs to happen. And then he's going to tell me. I would encourage you not to approach your business that way. Approach your business as though it's your responsibility to understand the detail, to understand where the business is going, to understand its profitability or its loss and where that's happening. And probably foremost, to understand where you are from a cash perspective. We'll use this term in the future, cash is king, but it's so important for you to know where and how much cash you have, capital you have available to you to run your business. Okay, so we talked about that. Let's jump into a couple of other topics that would be helpful. Accrual versus cash basis statements. So within any accounting system, you should be able to look at your business as an accrual versus a cash basis system. Cash basis effectively means, sales are recorded when cash is received. So I have a booth at a farmer's market, and somebody comes to me and buys, something that I'm selling, and I record that sale at the time the cash is transacted. That's cash basis. That effectively is what cash basis is. Expenses and products purchased are recorded when the cash is paid out. So if I have a product that is based upon glass, for example, and I buy glass from somebody, I record the expense at the time I pay them. That's a cash basis. Accrual is different. So sales are recorded when earned, regardless of when the cash is received. So my business is a little different. I'm not a booth at the farmer's market. I'm actually selling stuff out of my online website, and I give people terms. I allow them to take the product and pay me in 30 days. That starts to generate what's known as the accrual basis. So I don't record that sale at the time it's transacted. I record that. I record that sale when it's transacted. I don't record that sale when the cash is received. Right. Accounts receivable is how you keep track of those sales. So when goods and services are delivered or provided to a customer, the money is collected later. right? And most businesses work on an accrual basis. Most businesses will allow you to buy their products or services, and they will bill you. That plumber, right? He would have asked me to agree to a quote, which is different than paying for the product. But had I agreed to let him go forward with the project, I would have probably paid him sometime in the future. He would have accrued that sale and kept track of it so that he knew I still owed him that money. He would do that through accounts receivable. So accounts receivable tracks what's been billed but not yet collected. And we'll talk a little bit about accounts receivable here in a few slides. Expenses and products purchased are recorded when incurred or received, regardless of when they're paid for. So in my software business, I didn't pay employees every day for their day worked. I paid them every 2 weeks. So they accumulated hours. I kept track of those hours, and those were expenses that were recorded and incurred, but I didn't pay them until payday came due in 2 weeks. That's another function of accrual basis. This shows up as accounts payable. When expenses, goods, or services are incurred and received, so I receive products or raw materials that I buy from somebody, and I pay for them later. Typically, I pay for them based upon the terms of the purchase order that I give them. Maybe that's 30 days, maybe it's 60 days, whatever. But that's how the accrual system works. Accounts payable tracks what's owed, but not yet paid. The accrual system allows you to match what you've earned with the cost you've incurred to show if you're making a profit or not. And that's a helpful aspect of accrual systems, or working on an accrual basis, is I can line up my expenses with my revenues or sales, and I can see in the month of December, for example, how I did. Here are my sales, here are my expenses, did I make a profit? Those kinds of things are really helpful from an accrual basis point of view. So on the screen is a format of an income statement. It's for a fictional flower shop. And for a moment, before we get into the numbers, let's just focus on the format of the report and see how it's structured. As I mentioned, this report is called an income statement, but it might also be known as a profit and loss statement. They're synonymous, they're the same thing. What you want to do is you want to go to the top of the report when you sit down and look at it and get grounded on what it's telling you, okay? So we can see, for example, it covers a period of time. And in this particular case, it's December. So it covers the month of December. It could cover the first quarter, or it could cover a whole year. But in this particular case, we're looking at the month of December, and we're looking at it in terms of the current year. So in the current year, this is how I did in the month of December. Next to that, you can see the prior period. And this is where you start to get context by comparing your current period to your prior period. You start to see whether your month of December in the current year, how it compared to the prior year. Was it better? Was it worse? Did I do better in some areas and worse in others? So that's what this is all about. And that's what you're looking at. You're also seeing a percent of revenue column. So if you start from that column that says current year, then you get to a percent of revenue. Percent of revenue is a simple transaction that basically says, I take that number in the current period and I divide it by the total revenue or total sales, and it gives me a percentage. And that's helpful to be able to look at your profit and loss statement and see where big percentages are. Remember, we talked earlier about wanting to focus on those areas where there's a big impact. If you're looking at this percentage of revenue line or column, and you see, there's 5.5% of your revenue is taken up by delivery, but there's almost 50% taken up by reoccurring floral services, then putting your emphasis and focus on the reoccurring floral services makes more sense, right? That's where more of your revenue is coming from. That's where you want to spend time focusing. That's not to say that the smaller numbers aren't important, but you're going to have a limited amount of time to work on these financial statements. Focus on the ones in the areas that are most important to you. Excuse me for just a second. Okay. So some things to look for here. You've got your current period, you've got your percent of revenue, prior period, percent of revenue, then you've got your percent change, right? Excuse me, then you've got your change, the dollar value of the change, and then you've got the percent of change. So now that starts to help you see how you're shifting, how you're improving or not between current period and prior period. The first part of the report is about money in. So this is sales. It might be called revenue in other reports, but sales and revenue, again, are kind of terms that are interchangeable. And this is where money coming in is recognized. You can also see that in this particular report, what they've done is they've broken their sales out by category, right? So this is helpful as you're building your business, and perhaps you have multiple products or multiple services, to be able to recognize revenue based upon the product or the service that you're offering. This gives you great insight into which ones are doing better, which ones are doing worse. It also starts to give you some insight a little later on which ones are more profitable. Next comes your cost of goods sold. And now these are directly variable costs related to your sales. So here you've got things like material. In this particular case, it's a flower shop, so you've got flowers are probably incorporated into these costs. You've got direct labor costs that are associated with them. You may have packaging costs, that kind of thing, are all associated with these cost of goods sold. Now, the thing to remember here is that, hang on just a second. These are directly connected to your sales numbers. They're variable costs. If your sales go down, then your inventory will go down. Then your labor, your direct labor will go down. So those are costs that are very specifically tied, variable costs tied to your sales. If we go to this next section, excuse me, let me kind of cover this real quickly. So this notion of gross profit is taking your sales number minus your cost of goods sold gives you your gross profit. This is also called gross margin. And it's an important number to keep track of because you want to be able to see that your gross margins are getting better over time. You're becoming more efficient, more productive, and that's an important part of your business. The next section here is general selling and administrative costs. Now, these are costs that you're going to have regardless of whether you're selling a bunch or not. Maybe you've got a storefront, but business has dropped way off. You're probably still stuck in a lease. So these are kind of fixed costs. They're oftentimes called fixed costs. But these costs are looked at a little differently. They don't tend to vary with your sales. So you've got fixed costs that are going to be labor related, and you've got fixed costs that are going to be fixed expense related. So these are going to be marketing and advertising. They might be insurance. They might be building costs. They may be vehicle costs, those kinds of things. They tend, and they are part of your profit and loss that you've got to consider. So if you take your gross profit that we looked at earlier and minus your operating expense, then you come up with a net operating income. So that net operating income is basically telling you how your business is doing prior to considering some other expenses. So those other expenses are going to be things like interest expense, amortization, depreciation, those kinds of things that are part of running your business, but are categorized separately. So they're not part of your variable expense. They're not part of your fixed expense. They're calculated separately. Any questions before we move on? Okay. So one of the things that's important to note here is that you can have a profitable business, right? You can see profits month over month, quarter over quarter, but still run out of cash. It happens a lot, probably more than I'm aware of, but it's a problem that entrepreneurs and business owners have, is they see themselves being profitable, but they don't have cash to fund their operations. And that's something we'll talk about here in the next couple of minutes, is that notion that if you don't have cash, you need to know where your cash is going. And there are a few areas that are helpful to recognize that. The next thing we're going to talk about is balance sheet. So the balance sheet helps you understand your assets and your liabilities and your owner equity. It's structured very similar to the income statement that we looked at. But in the balance sheet, one of the things that's a little different is that it's a statement as of a specific date. So you remember the income statement was the month of December, from the beginning to the end. This balance sheet is as of typically the last day of the month. So that's where you're going to be focusing your attention. This is what the last day of December looked like. So it gives you sort of a point in time. So it's broken out between assets and liabilities. Assets are on the left-hand side. Liabilities are on the right-hand side, along with owner equity. And a key concept here in the balance sheet is assets equal liabilities plus owner equity. That's a concept that we'll talk about in a little bit, but that's one way to know whether your balance sheet is in fact balancing, is where your liabilities and owner equity equal your assets. So the first section of your balance sheet is current assets. So these are assets that are convertible to cash within the next 12 months. So these are going to be things like cash. They're going to be accounts receivable. They're going to be inventory. And those are typically set up and called current assets. They're also called working capital. And this is a part of your balance sheet that's going to change sort of month to month. So it's important to have that comparative analysis to be able to see how things are changing for you. The next section is fixed assets. So fixed assets are property and equipment, which typically have a life span greater than 1 year. So these are things that you might have in the way of assets like buildings or vehicles that help you deliver your products or services, but they they're not current. They don't expire within a year. They have a lifetime longer than that. So those are called fixed assets. And then you have intangible assets. And these could be things like patents, goodwill, different lists, maybe they're customer lists. If you're a franchise operator, they're part of your franchise licensing, those kinds of things. They could be, oh, I mentioned patents already. They could be patents. Patents are typically other kinds of assets or intangible assets. On the other side are liabilities. Okay, so liabilities are structured the same way as assets. You've got current liabilities, and then you've got longer term liabilities. And these tend to be where assets were things that you owned, liabilities tend to be things that you owe other people. So this tends to be things like accounts payable. This might be loans that are due to you know, stakeholders, investors, banks, those kinds of things. So it's important to recognize that liabilities are broken down into two sections, current liabilities and long-term liabilities. There's a ratio that bankers often use that look at current assets and compare them to current liabilities. And you want to have your assets greater than your liabilities in that ratio, because that's a quick way to understand liquidity in your business. So the next section here is owner equity. And owner equity is kind of an interesting concept, because not only is it all about you know, what money you've put in, but it's also information relating to things like retained earnings, things that you've paid out to owners or to investors. So there are a lot of things that are involved here. So one of the things that's important to recognize is that owner equity is kind of a sense of where you are with regards to your business, both from a retained earnings perspective and from a current year earnings perspective. And again, taking liabilities, adding owner equity to them should produce a figure. In this particular case, you can see it down here at the bottom, you know, $398,000. And what you should be able to do is go over to the asset side and see that same figure, $398,078. So this gives us a sense that the balance sheet at least is balancing. It's not to say that it's perfect and there are no errors in it, but it does give you a sense that you're balancing here. So you're comparing money in transactions to money out transactions, and you've got a sense of balance. I'm going to stop here for a minute and see if there are any questions, and also check chat just to see if anybody has one. Any questions before we move on? I know I'm going through this kind of quickly. There's a lot of material here that I think will be helpful for you. So if you do have questions, let me know, raise your hand. Otherwise, feel free to email me after the presentation. I'll be glad to answer any of them that I can for you. So the next document that we're going to look at is the cash flow statement. Cash flow statements cover a period of time, kind of like the income statement did. And often what you're going to see is you're going to see a starting balance of cash and then an ending balance of cash. So starting balance of cash will be at the top, ending balance will be at the bottom, and all of the transactions, positive and negatives, will show up in between. It in this particular case, it shows the month of December. And one of the ways that you should read cash flow statements is recognize that positive numbers reflect money that comes into the statement, and negative numbers reflect money that goes out of your cash flow. So money that you spend. And sometimes that gets confusing So we're not going to spend a ton of time on this, but I want you to make sure that you recognize when you look at cash flow statements, positive numbers are money coming in, negative numbers are money going out. Okay, you start with the beginning balance, then your beginning balance plus your inflows minus your outflows equal your ending cash. It just kind of makes sense. But your beginning balance is listed here. And much like the other reports, you see your current period and then prior period. And then you can see a percent of change and the dollar change. As I mentioned earlier, it's important to recognize and have that context of how am I doing, not just in the current period, but comparing that to prior periods. So the first section is inflows and outflows from the income statement. This is kind of where you recognize for the month of December from your income statement, you know, what kind of net income did you have or profit did you have or loss if it was a loss. You also will look at things like and make adjustments for amortization and depreciation. These adjustments take place because they're non-cash transactions, and you want to be able to align this report with your income statement. Next, you're going to want to look at inflows and outflows from your balance sheet. This is where about 80% of your transactions are going to come from, is from the balance sheet. And you can see that they're broken out between current assets and fixed assets and what's happened, what's come in, what's gone out. And then also you'll see a section in here for, a section in here for long-term section of the balance sheet that show up on your cash flow statement. So these are broken out. You look at them from the point of view of positive means cash coming in, negative means cash coming out. And so you can kind of see as you go along how that impacts your ending cash balance. And you can see from this report, you know, we started with $270,000. We ended with $254,000. That means that we used about $16,000 in cash. And if you go up and down through this report, you can see where those changes came from. So what we're going to do next is we're going to start to focus a little bit on that current section of the balance sheet and talk a little bit about things to look for with regards to changes that you see in the balance sheet. And the first one we want to look at is changes in cash balances. So you can see that, you know, for the current year, our cash balance is $254,000. We saw that number on the cash flow statement. We can look at the prior year number and see that it was $148,000 in the prior year. So obviously cash is increased by $105,000. That's a good thing. That's what you want to see. But is that a temporary issue? And why is cash going up like that? So it could be tied up in all kinds of different categories within the balance sheet. It could be issues where, you know, maybe you had a debt payment that took place at the end of last year that isn't due this year. So that may have contributed to it. So you need to understand and see from the cash flow statement where and why your cash balances are changing. And you should be able to see that month to month based upon that cash flow statement. And it will be reflected on your balance sheet here. Here we go again with that notion of cash is king, right? Running out of cash is the number one reason small businesses fail. So making sure you understand cash is a big part of this report. The next thing you want to look at is accounts receivable. So accounts receivable, as we talked about earlier, is really where money is owed to you or your business by your clients. So if your accounts receivable is going up, that means you're not collecting as much money and people are holding your money for longer periods of time. And that's usually a bad thing. But sometimes it's good because, my sales are increasing, so my accounts receivable is going up. Sometimes that's great. But if your average sales of your receivables has increased, then that's typically not a good reason. That's typically a bad reason. So we'll talk a little bit about accounts receivable here as we go along, and look at some reports that might be helpful in kind of picking this apart and understanding where your issues are. Here is an accounts receivable report. So across the left-hand column, you can see the client names, and across the top of the report, you can see the time frame. So 0 to 30 days, 31 to 60 days, 61 to 90 days. Typically, what you're seeing here is how long between the time you sent your invoice to the client and how aged that invoice is. Now, most companies will have terms like 15 days or 30 days, sometimes 90 days, 60 days or 90 days, but that's very rare. So you want to make sure that you're looking at your accounts receivable report and recognizing where each of your clients are with regards to where their aged invoices are. It's important to understand that. So let's see, I've got a couple of things that have come out. Got it. I'm just looking at chat to see if I can answer any of these questions. We'll just keep going, and I'll try to pick that back up here in a little bit. So that's accounts receivable. Interesting fact with regards to accounts receivable is oftentimes in companies, this task of collections is relegated to a bookkeeper or somebody else in your company. It's important to recognize that this is a major use of cash in your business. So if your accounts receivable starts to grow, you want to make sure that you know and understand why it's growing and which of your clients is past due in payables. And sometimes that means you have to get on the phone, call them, and talk to them about paying your bills, because effectively they're holding money that they agreed to pay you for your goods or services. So that's an important thing to look for. Here again, that message of don't delegate the management of this review. Make sure that you stay on top of this. Typically, a weekly customer review is an important part of keeping your accounts receivable current. So looking at this from an AR management point of view, one of the things to consider, particularly if you're a service provider, like a contractor perhaps, maybe you're working on long-term projects, landscapers typically have a problem like this. You've got a long project, it requires you to buy materials and commit labor to it. But if you're not asking for payments while the project is ongoing, a lot of times you can find yourself strapped for cash because you're investing money into this project, but if your client isn't paying you until the end, it becomes problematic for you. So one of the things that helps in that regard is thinking about it in terms of, are you doing progress billings or draws for the project? If you're buying landscaping material or you're paying labor, make sure that if that project is lasting a month or 6 weeks or whatever, that you have the ability to do progress billing or draws against that project. Are you doing fast turnarounds for progress billings and draws. A lot of times what happens is, you'll create an invoice for a progress billing, but the customer doesn't pay you right away. So that will show up in your accounts receivable report. But also something that you may want to do is recognize the fact that as long as you're in that project, as long as you're on site, you're going to have much more leverage to collect progress billings or any kind of billing. So make sure that you recognize that before you leave the site. It's often harder for people to not pay you while you're still on site. One of the things that oftentimes comes up is this notion of, how do I bill so that my accounts receivable is maintained and is healthy? And one of the ways to do that is kind of comparing two business types. And one of them is a pest control, and one of them is a lawn service. And so the story is that from a pest control perspective, I have a pest control service that comes to my house. They provide their service and they bill my credit card as soon as they're done, right? They come to the door, they knock on the door and they say, okay, we've completed your service. I'm going to build your credit card. Please sign here. And so they get paid right off the bat when they deliver that service. Another vendor that comes to my home is my lawn service provider, the guy that does my lawn care. And what he typically does is he'll show up, he'll mow my lawn, he'll do that kind of stuff, and he bills me each month. So which of those two businesses would you expect provides the best cash flow for the company? Well, the pest control model definitely provides the best cash flow. They come, they do the service, they get paid, versus the lawn service who provides the service during the course of a month and only bills you monthly. So that's something else to keep in mind as you start your business up is what can you do from a service perspective to ensure that you're billing more frequently and people are paying you on time? Okay? Going back to that whole notion that cash is king. So there's a ratio that's called accounts receivable turnover. And this is an important ratio because it kind of gives you a sense of how often you are turning over your accounts receivable. They often call this days of sales on hand or days of sales receivable. And the way it works is this. Let's say you have annual sales of $600,000 and your average accounts receivable is $50,000 each month. So what that means is with $600,000 of sales during the course of the year, you basically have 12 turns or 30 days of sales and receivables each month. That's actually a pretty good ratio, right? You're keeping current with your accounts receivable, people are paying you regularly, and so that's a pretty good performance for a company. But let's say that same company had annual sales of $100,000. So that means that they're only turning their receivables over 6 times a year, which means that they're turning their receivables over every 60 days. That's very expensive because what's happening is they're not getting their money as quickly, right? If you have a balance of $100,000 with $600,000 in annual sales versus a balance of $50,000 for the same amount of sales, you can see that that isn't turning your cash back into the company as quickly. One of the things that's important to recognize is what is the benchmark for your industry. So going back to that notion of joining trade associations or industry associations, one of the things they can often tell you is, what are the ratios for your business? What are the benchmarks? And being able to benchmark accounts receivable is helpful. It kind of gives you an insight into how you're doing. This is also a key ratio for bankers. If you're going to go for a loan or you're thinking about selling your company, bankers and buyers are going to want to see how quickly and how often you turn over your accounts receivable. Think about it in these terms. If I'm buying a business and I see it has a large accounts receivable and its days of sales on hand are 60 or 90 or 120 days, what that's probably telling me is they have issues with their quality of products or services, and people aren't paying them on time because they have issues and they're trying to use their payment as leverage to get things fixed or to encourage the business owner to do something for them. And last but not least here, receivables can eat up your cash flow if not managed with a strong discipline. And again, going back to that notion of looking at your accounts receivable on a weekly basis, making sure that you're keeping track of it. Your cash can slide away quickly if you're not keeping track of AR. Another thing that's going to eat up a lot of cash is inventory. So you'll see this on your in the current section of your balance sheet under assets, and looking to see how inventory changes is also another way to understand how your business is doing. If sales is increased and inventory is increased, well, that's probably okay. You should still investigate, but it's probably all right. But if the average age of your inventory has also increased, so your inventory is growing, but not necessarily in line with your sales, that may mean that you've got inventory that's not turning or not being used quickly. That opens you up for obsolescence, that opens you up for spoilage, whatever the case may be. You want to make sure that your inventory, like your AR, is turning quickly. So one of the things that contribute to inventory increases, price increases on your merchandise. That's something to look at. Be aware of it, particularly in this time of inflation. That's not unusual to see price increases that impact your inventory levels. If they impact your inventory levels, what else is going to get impacted? Your cash, right? So your cash is going to go down as you build up or buy inventory. You may also have another issue, which is, your inventory may be used for other purposes other than selling your products. And one of those purposes, unfortunately, is your inventory may be stolen, or it may be being used unbeknownst to you for other things. So it's important to look at ways to control your inventory so that you know where it is, you're confident that it's being used appropriately. And you can do that through physical inventories, you can do that through a wide variety of security measures. But it's important to keep an eye on that inventory, particularly using the current section of your balance sheet to understand where it's going, to know how your inventory is being used. So there are a couple of things to keep in mind with regards to inventory purchasing. So obviously purchasing is a big part of inventory management. And one of those things is understanding lead time or order quantities. So lead times equal the time between ordering and receiving merchandise. And this has a big impact on cash. So if you're ordering inventory maybe once or twice a year and working it off during the course of a year, what you're doing effectively is you're tying your cash up. So ordering in smaller quantities and using that inventory more frequently is oftentimes a better practice. It's important to recognize as your business grows or changes where that change is occurring and adjusting your ordering practices based upon requirements. So look at your sales forecasts. make sure that your inventory supports your sales, but also make sure that if sales are starting to decline, you take action with managing your inventory. You don't want to be stuck with a lot of unnecessary inventory. If cash is tight, establish an open to buy kind of process where you only buy inventory based upon having orders on hand. That sometimes is a practical approach. Here's a good example of buying efficiently. So what you can see here is two scenarios, right? First scenario, we buy every 3 months. And so we buy once a quarter for $30,000. We buy $30,000 worth of inventory. The second scenario is we buy that $30,000 of inventory once a month, or $10,000 a month. Our payment terms to our vendors is 30 days. So that's when you have to pay them. They're a retail purchase with no receivables. And so basically what this is saying is, I get paid when I deliver the product, and assume a 35% gross margin on the sale. So let's look at how these two scenarios line up. So the first scenario, what we see in month 1 is that $30,000 expense for inventory. We see inventory being used at a rate of $15,400 per month, which means that we've got $14,800 of inventory sitting on the shelf waiting to be used at the end of that month. So we've used some of it, but we've got this inventory left over. Month 2, we use 15,400 of inventory again, which means that we've still got $800 of inventory sitting on the shelf waiting to be used the last month. And then you can see again, the third month, how that works out. We're using 15,400 and we use all our inventory up at this point, okay? So the next scenario where we buy inventory once a month has a much different outcome. You can see the $10,000 expense for inventory in month 1. You can see that 15,400 is being used, and effectively what you've got is you've got a cash surplus. So you've sold 15,400, but you've used 10,000. So now you've got positive cash flow of $540. The next month, you buy another $10,000 worth of inventory. You sell another 15,400. But what happens here is now you've sold another $5,400, but now you've cumulatively got you've got $10,000 of cash available to you. And the same thing occurs the third month, right? You buy $10,000 worth of inventory in month 3, you sell it, you get the profit from it, which is $5,400, and now you've got $16,200 effectively in cash available to you. You can see that in the first scenario, it's a much better approach to managing your inventory. You're getting cash flow much earlier in the process, in the quarter, than you do in the first scenario. Hopefully that makes sense and you can see how that works. Being able to buy inventory on a shorter time scale helps save cash, much like being able to manage your accounts receivable, and getting those turns in accounts receivable quickly helps save cash. Accounts receivable and inventory are going to be your two biggest users of cash. So there's a similar ratio in inventory than there is that there is in accounts receivable. And this basically looks at inventory turnover or inventory turns. And that's the way you kind of evaluate how quickly is your inventory turning, right? So if we take a look at this example, we've got an annual cost of goods sold. So it costs us $100,000 to provide our products or our services to our clients during the course of a year. and we have an inventory, an average balance of inventory of $100,000, which means, right, if it takes me a year to use $100,000 and I have $100,000 on the shelf, that means I'm turning my inventory once a year. Does that sound good to you? Because it's not. It's a tough way to go and a tough way to run a business if you've got that much inventory sitting on the shelf. So if you had, for example, $25,000 of average monthly inventory balance, you'd be turning your inventory 4 times a year, right? 25 goes into 100,000 4 times. And effectively, what you're doing is you're saving $75,000 in cash by turning your inventory every quarter, essentially, or every 90 days. So that's a big savings to you. And that means that you've got a lot more cash available to your business if you're turning your inventory more frequently. Again, what's the benchmark for your industry? That's something that's helpful to understand. Going back to these trade associations or industry associations, they can help you tell you that if you belong to them and if you're part of them and contribute to that community. Much like accounts receivable, this is also a key ratio for bankers. If you're a product-based company, they're going to want to see how quickly you turn your product. And an example of this where it's not working well would be if if you have $100,000 in annual sales and you've got $100,000 of inventory on average each month, and you're turning your inventory once a year, that typically tells a banker that you've got obsolete or spoiled inventory and that you're not ordering your inventory in the proper rhythm or sequence, and you probably have some kind of product problem where you're not selling as quickly as you thought you would. So that's a big piece of what bankers or investors or buyers are going to look at is how does that all work? And much like accounts receivable, the inventory will eat up cash. So the next one that we're going to talk about just briefly is accounts payable. So as the term implies, this is how frequently you're paying people that are selling you products or services. And this is an important part of running a healthy business, is making sure that you're paying your vendors on time. If the unpaid invoices are increasing, then that's usually a problem that either says that you don't have enough cash, or that you have issues with your vendors, or that you have internal issues and people aren't paying attention to accounts payable properly. One of the things that's important here, much like your accounts receivable, accounts payable is something that you should, as a business owner, pay attention to. If you relegate that to a bookkeeper or somebody in your accounting department, make sure that they feel comfortable bringing bad news to you, and they feel safe in being able to approach you with problems. One of the issues that I see a lot in companies is that the owner or the manager of a department or a company is bristly when they get bad news. And what's going to happen with that is people are going to be reluctant to share that with you. So make sure you don't shoot the messenger when it comes to how you're paying or how you're managing your people. As the note says, request to see your accounts payable aging report each month. And if cash is tight, maybe you want to look at that weekly. Make sure that you understand what vendors you want to pay, what vendors are critical to you to keep your products and services going, and prioritize them if cash is tight and you have to. The other thing that you want to do is you want to make sure that in your accounts payable process, you make sure you're looking for key issues in invoices that you're receiving. So you want to make sure your unit prices are correct, your quantities are correct. This is where accounts receivable, the receiving department and accounts payable have to work together to make sure that you're getting the quantities that were ordered are being delivered. That's oftentimes a big problem where you order 100 pieces and a vendor may deliver 50 to you and they may owe you 50. Making sure you're not paying invoices as though the complete amount was delivered is important. So make sure unit prices, quantities, discounts, unapproved extra charges, which sometimes show up, duplicate invoices, all of those things need to be looked at carefully as you look at and bring in material into your organization. You also want to make sure that when it comes to vendor credits, you have the most leverage before you pay. So if you've got an issue with a product, work that issue out before you pay the invoice. After you pay the invoice, it's likely that the vendor that you're working with is less inspired to solve whatever problem there might be, or deduct the payment from the next invoice. So that kind of concludes what we've talked about this evening. Hopefully you've gotten some benefit out of it and there's some information here that's been helpful to you. There's a second part to this workshop, part 2, which will take place on the 24th. And there we'll talk a little bit more about the income statement, pricing templates, key metrics to look at, and those kinds of things. If you have the time, I'd love to have you participate in that. So let me see if there is anyone else that has a question. Doesn't look like it. Thanks everybody for the chat. Looks like there's been some good information exchanged. And that's it for me. So over to you if you have any closing comments. Andy, anything else you want to add?
Somebody was asking about scheduling appointments with SCORE to get help with financial statements. What is the best way to do it, Mike? Can they email you or how does that work?
So probably the best place to get a mentor assigned is to go to the score.org website. There's a tab there for selecting a mentor, and just fill in the information. And what will happen is, based upon the information that you enter in that dialog box, they'll assign a mentor based upon what you're looking for. So that's probably the best way to do it. If that doesn't work for you, feel free to email me. I sent some emails earlier today and yesterday. You've got my email address, and I'd be happy to help there too.
All righty. Well, thank you, everyone. Thank you, Mike.
You betcha. Thank you. I hope everybody stays safe in the storm, and I hope to see many of you next week.
Stay warm.
Okay.
Bye-bye.
Take care. Bye-bye.